Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock, with news of some dramatic changes in the rate of funds that are flowing out of China. But first, the International Demographia annual survey is out today for September 2016, and 7 of 8 New Zealand cities feature in its most unaffordable rankings. Demographia's data is a little suspect and a little dated, but the overall general relationship is probably about right, and it is the only international study in this detail. According to this metric, the most unaffordable city in their rankings is Hong Kong, followed by Sydney, Vancouver, Santa Cruz, California, Santa Barbara, California, and then Auckland is number 6. Last year, Auckland was ranked as number 5. China's currency outflows have changed from a flood to a trickle, with less than $1 billion in December flowing out and far less than the fast outflows reported in the previous 7 months. New regulations and limits are having a dramatically quick impact on the ability of Chinese citizens to move money out of their country. That's less than 2% of the record amount in September and compares with an average outflow of $26 billion a month in all of 2016. And staying in China, we're approaching the week-long Chinese New Year holiday, a time when the banking system there and their liquidity undergoes major stress. This year, their central bank has decided to offer major banks a 28-day liquidity facility to help them cope. In Europe, there's growing nervousness about real estate valuations. These are highly correlated to bond yields, and as those bond yields rise, property valuations are very likely to fall. In fact, that's what the Europeans are now finding. A key indicator is now on the verge of falling below a technical threshold that has acted as a support since 2009, which would be a strong bearish signal. These market basics probably apply here too. And if you have an insurance or funds investment plans with ANZ, and that includes KiwiSaver funds, you'll probably want to know that ANZ Bank headquarters in Melbourne is busy preparing its ANZ Wealth business for sale. And all sorts of European, Japanese and American businesses are lining up to bid to buy this division. The AFR is reporting that Goldman Sachs are doing the selling for ANZ and that there is pressure to sell their life insurance part separately from their wealth part. You may have your relationship with ANZ now, but that may change fairly soon. It is not clear yet how much of the New Zealand parts will be hived off with the Aussie bits. In New York, the US Treasury 10-year yield actually rose to over 2.51 on Friday, but then slid and will open this week at 2.47. Oil prices are a little higher today, now just over $53 a barrel for the US benchmark, while the Brent benchmark is now just on $55.50 a barrel. There was a big jump in the number of new wells brought back into production in North America last week. In fact, it was the largest gain in 285 weeks, and the second largest in over 10 years. Meanwhile, OPEC is claiming their output restraint is ahead of target. OPEC just seems to be making space for American frackers to profit. The gold price rose just ahead of the swearing-in of the new US administration and now just sits at $1,210 an ounce. History shows that gold prices rise 15% in the first year of a new president of the US, but there are exceptions. That didn't happen for Reagan nor for either of the two Bushes. New Zealand dollar has moved very little over the weekend and will open at 71.7 US cents. On the cross rates, it's 94.8 Aussie cents, and against the euro at 67 euro cents. TWI is at 77.5. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.